Good evening, all of you. And in the last class, I finished about this change of method and annuity method. Now we are going for the fourth method, that is nothing but depreciation fund method or sinking fund method. So, what is this depreciation fund method and or sinking fund method? Whatever it may be, the depreciation amount that we are calculating, we have to transfer that amount of depreciation to a separate account known as depreciation fund account, or it can also be called as sinking fund account. So here the depreciation, how we will calculate. Okay, this depreciation amount every year, how we have to calculate is, we have to take into account the number of years what he specifies, and the percentage of depreciation, and what will be the depreciation for 1 rupee. That thing we have to take into account, and with that amount we have to multiply with the cost of the asset. So thereby you will come across some amount of depreciation, and that amount only you have to take every year. Once again I'm repeating this, Amma. Okay, you have to take into account the number of years and the rate of depreciation. And for 1 rupee, what will be the depreciation or depreciated amount we have to calculate? And that amount into cost of the asset, whatever it may be, the cost of the asset, you have to multiply that. So thereby you will get some amount, and that amount only you have to take that as depreciation. And this depreciation amount, whatever it may be, you have to transfer to a separate account known as depreciation fund account or sinking fund account. And from this depreciation fund, from this depreciation fund, you have to go and you have to invest that too in short term period. That is, say for example, 1 year. So for every 1 year, you have to use this fund, use this amount as an investment. Thereby, after 1 year, automatically you will get some interest amount. And mind it that interest amount, it won't be big, it will be less. So whatever it may be, the interest that you come across, you have to take that and you have to transfer that to again to depreciation fund account. And transferring of depreciation fund, it will be a continuous process. Whatever it may be, the depreciation that we come across, we have to take that and we have to transfer that to depreciation fund or sinking fund account. Along with that, whatever it may be, the interest that you receive from these investments, you that amount also you have to transfer. Like that, you have to transfer the interest amount as well as the depreciation amount, depreciation amount to the fund account, and again from the fund you have to go for investments. When you are going for investments, what is the name for that? Depreciation fund investments account, or some people they'll call that thing as sinking fund investment account. In any way you can call, in any way you can call, whether you call in depreciation fund investments account or sinking fund investments account, in any way you can call that. But the investments must be for a short period of time, say for example 1 year. And after, you should not go for a longer period of time, just 1 year, short term investments. And after that, whatever interest you make, you will come across that amount also you have to transfer to depreciation fund account. So like that, you have to continue until the period is completed. Now at the end of the period, you have to sell the depreciation investments, whatever you are having in the open market. And by getting some amount, some amount, you have to transfer that to depreciation fund account. Naturally, you will get some amount, and that amount you have to transfer to depreciation fund account. So thereby, you will have some amount, okay, for the replacement of the asset. Okay, when you are selling the investments, sometimes you will come across profit and sometimes you will come across loss. But whatever it may be, that profit amount you should not touch. You have to transfer to depreciation fund. Okay, when you get profit, it will be added. When you get loss, it will be deducted. That is, depreciation fund will increase or decrease. When you get profit amount, it will increase. When you get loss, it will decrease. Okay, and from this depreciation fund amount, you can be in a position to purchase the new asset in the place of old asset. In the place of old asset. Okay, you are having. And suppose if there is any balance, that balance you have to transfer to general reserve. So like this, you will come across the fourth method. In fourth method, in fourth method, what is going on? We are having some amount, okay, we are getting some amount in the form of investments or in the form of fund, okay, to replace the old asset with a new asset. There is no necessity for the businessman to take money from his pocket and spend that. There is no necessity for any business person or organization that, that I'm spending this much amount for me, that I'm investing this much amount to replace an asset. So the depreciation itself, it will provide some fund, some amount for the replacement of the asset. So like this, you will come across the sinking fund method or depreciation fund method. And you have to observe one thing. You have to observe one thing. Here, when we go for depreciation fund method, you will come across some journal entries and some ledger accounts. And this ledger accounts and journal entries, you must be very thorough. When you are thorough with this journal entries, automatically you can go for ledger accounts. That is a secondary issue, secondary thing. Okay, but thing is, you must continue until the time period specified. Suppose if you say 5 years, you have to write journal entries for 5 years. If you say 7 years, you have to write journal entries for 7 years. And when you are going for ledger accounts, you have to show 7 years accounts, 7 years accounts, okay, in that ledgers. And you will come across the dates. You will come across, don't be of that opinion that we won't come across any dates. Compulsory, you will have the dates with you. And according to the dates only, you have to proceed. So that is the main thing that you have to keep in your mind. So depreciation fund, from the depreciation amount only, you are going to get this depreciation fund. Because every year we have to calculate, that is, of course, not every year. Every year you have to transfer the same depreciation amount to the depreciation fund account. So when you are transferring to depreciation fund, automatically it gives that you are getting some money, you are getting some income. For what purpose? For the purpose of replacement of an asset. When you are investing the money in short term investments, you are getting the interest. That thing also you are not taking, you are not using, and you are transferring to depreciation fund. And when you are selling the investments in the open market, whatever may be the money that you are getting from this investments, that thing also it must be transferred to depreciation fund. Then automatically it is obvious that you are getting some money, and that money, what the businessman or what the organization will do, they will use that money for the replacement of old asset with a new asset. And whatever it may be, the balance that is left over, it will be transferred to general reserve as a fund. So this is the fourth way of calculation of depreciation: depreciation fund method or sinking fund method. This is the thing that we come across. Okay, so I mean the advantage of this is people, they are going to get money from depreciation. They are going to get money from depreciation to replace the old asset with a new asset. That is a main benefit. And what is the drawback? What is the disadvantage? So, unless otherwise you won't understand clearly, it seems to be very complicated. Okay, so you please keep your mind when you are going to do this depreciation fund or sinking fund method. Okay, properly. You have to understand about the journal entries. Okay, and you must be in a position to prepare journal entries for the given period, whether it may be of 5 years or whether it may be of 7 years, whether it may be of 11 years, whatever it may be. Okay, you must be in a position to pass the journal entries without any mistake. When you pass journal entries without any mistake, automatically you can prepare the ledger accounts without any struggle, without any problem. And you will come to know how much money the organization people they are getting by transferring the depreciation to depreciation fund account. And what he will do, he will replace the old asset with a new asset. That is the main advantage that you come across in this depreciation fund account. Now, the fifth one is insurance policy method. Insurance policy method. Okay, this is the fifth method that we are going. Okay, I'm just giving that insurance method and I'll explain that. Okay, there is no necessity for you to may break your heads, please. I'm going to explain this insurance policy method and the other methods. When we study this insurance policy method, still we are having three methods. Total eight methods. Don't forget that. So, this method is similar to depreciation fund method. The difference being that instead of purchasing investments instead of purchasing investments, an insurance policy is taken with which will fetch at the end of the fixed period the required amount. Premiums have to be paid at the beginning of the year. No entry is made for interest, or as interest will not received, interest will not be received from insurance company. This is the thing. This is the thing that you come across. Okay, insurance policy method. Here in previous method, in fourth method, what we are doing is whatever it may be the amount that we are transferring to depreciation fund, we are taking that money and we are investing in short term investments. Say, for example, 1 year. Generally, 1 year. They won't go for more than 1 year, please. Okay, so whatever it may be, they are investing in short term, that is for 1 year, and all the money is whatever it may be, the investments, whatever it may be, you are going to sell after a fixed period of time, and you are going to get some money, and you'll see whether you got a profit amount or loss amount, and that profit amount or loss amount you are transferring to depreciation fund. Understood? And from this depreciation fund you are purchasing. But in insurance policy method, mind it that there won't be any investments. Whatever it may be, the money they'll take an insurance policy for the fixed period of time, for the fixed period of time, and you have to pay the insurance premium at the beginning only. That is, you have to calculate, you have to calculate, and then only you have to go for insurance policy, because the insurance premium you have to pay at the beginning of the year. That thing you should not forget. And don't be of the opinion that you are going to get interest. You won't get any interest amount. There is no question of interest. There is no question of interest. The thing is, whatever it may be, the depreciation amount and whatever you are transferring and whatever you are taking and investing, that amount, that amount, it will be insured. You have to take an insurance policy. Okay, that thing only the difference is, instead of investments you will come across insurance policy, and insurance premium must be paid in the beginning, and you should not anticipate any interest, and you should not think of any interest amount will, I mean, the interest amount will come on this. Okay, at the end of fixed period of time you can claim your money back. So with that claim and with that money you can go and replace the old asset with a new asset. This is nothing but one method. That is nothing but the fifth method. That is insurance policy method. Now we are going for the sixth method, sum of digits method. Sum of digits. So what do you mean by digits? Digits are 1, 2, 3, 4. No, sir. But why is giving sum of digits? That is the main thing that we come across. Under this method, depreciation is written off each year by the formula. Okay, depreciation is equal to remaining life of the asset. Okay, remaining life of the asset including the current year divided by sum of digits of the life of the asset in years into cost of the asset. This is how you will calculate sum of digits method. Suppose if the life of the asset comes to 10 years. Okay, first year you will come across depreciation. So when you come across first year depreciation, how many years are there? 9 years. 9, 8, 7, 6, 5, 4, 3, 2, 1. You have to add. That is nothing but sum of digits method. Now, remaining life of the asset, including the current year. Okay, including the current year, that is 10 by total 9 plus 8, 17, 17 plus 7, 24, 24 plus, okay, 6, 30, like that you have to total that. Okay, so remaining life of the asset, including the current year, by sum of digits of the life of the asset in years into cost of asset. So this is the amount that we come across as depreciation. This thing is also very, very rarely used. Don't be of that opinion. Okay, it will be commonly used. It is very, very rarely used. Okay, and you will come across some problems on this sum of digits method. Mind it. You'll come across some problems on this sum of digits method. But thing is, people they must understand the formula. Remaining life of the asset in years only. Don't be of that opinion that it will be in rupees. Remaining life of the asset, including current year, that is 10 years. 10 years by sum of digits of the life of the asset in years into cost of asset. when you follow this formula, whatever it may be, the amount that you come across, it will be treated as depreciation. And the same thing as usual, the same thing as usual. When you, if you go for just fixed installment method, you can go for fixed installment method. If you want to go for diminishing balance method, you can go for diminishing balance method. But thing is, depreciation is calculated with this following formula, with the following formula. Okay, now revaluation method. Revaluation method. So what is this? Revaluation method means whatever it may be, the asset that you are having now, it will be taken and it will be valued in the market. And whatever it may be, the value that you come across in the market, you have to take into account the difference of that value and the purchase value. So the difference is nothing but the depreciation. So that is nothing but revaluation method. Under this method, under this method, the assets are revalued at the end of the accounting year, and the difference between the closing and opening value is treated as depreciation. This method is used in case of, okay, bottles, corks, loose tools, livestock, etc. This is nothing but revaluation method. What is the opening value of the asset? And what is the market value of the asset? They'll take. And the difference will give you the depreciation. Like that, year after year after year, every year they will calculate the depreciation, taking into account the opening balance, opening value of the asset, similarly closing value of the asset, and what is the difference. That thing only they will take that as depreciation. And he had given you bottles, corks, livestock, all these things, they will follow this revaluation method. There is no hard and strict rule that you have to follow this method only. You can follow any method. You can follow any method. This is about. Now we are going for the last one, that is machine hour rate. Machine hour rate. Under this method, the life of the machine is fixed in terms of hours. Hourly rate of depreciation is worked out by dividing the cost of the machine by the total number of hours for which the machine is expected to be used. Depreciation to be written off in a year is is ascertained by multiplying the hourly rate of depreciation by the number of hours the machine actually runs in the year. This is about thing. Okay, machine hour rate. You have to take into account, okay, hourly rate of depreciation. Okay, is worked out by dividing the cost of the machine by the total number of hours for which the machine is expected to use. Expected to be used. That is the amount that you come across. Okay, depreciation to be written off is a year in a year is ascertained by multiplying the hourly rate of depreciation by the number of hours the machine actually runs in the year. How many hours the machine runs? We have to take that and we have to multiply this. So with this, I have completed all the 8 methods of depreciation, and after this, we are going to see the problematic portion. Thank you.